Have you ever wondered why two people can invest the exact same amount of money, yet one quietly builds wealth while the other loses confidence, gives up, and says, "Investing just isn't for me"? What if the biggest threat to your investments isn't the market, but the invisible mistakes you don't even realize you're making? Today, we're going to uncover the biggest investing mistakes beginners make without realizing it. Some of these mistakes seem harmless. Others feel completely logical. But together, they can quietly destroy years of potential wealth. By the end of this video, you'll be able to recognize these traps before they cost you money, confidence, and opportunities. And if you're interested in personal finance, investing, and building long-term wealth through smart decisions, make sure you subscribe to the channel and turn on notifications. Every week, we explore practical financial strategies and the psychology behind money so you can make better decisions for your future. Now, let's begin. Imagine a young professional named Alex. After hearing friends talk about stocks and seeing endless success stories online, Alex decides it's finally time to invest. The excitement is overwhelming. Social media is full of screenshots showing incredible profits. Headlines talk about companies reaching new highs. Influencers claim they've found the next big opportunity. Alex opens an investment account, buys a few popular stocks, and waits for the money to grow. But only a few weeks later, the market falls. Panic sets in. Alex checks the portfolio every hour. Every red number feels like a personal failure. Fear replaces excitement. Eventually, Alex sells everything at a loss. Months later, those same investments recover and continue climbing. Alex walks away believing investing is too risky. What really happened? The market wasn't the biggest problem. Human psychology was. The first mistake beginners make is believing investing is about finding the perfect stock. Movies and social media have convinced many people that successful investors constantly discover hidden companies before everyone else. Reality is very different. The world's most successful investors usually spend far more time avoiding bad decisions than searching for magical opportunities. Building wealth is rarely about one perfect investment. It's about making consistently good decisions over many years. The second mistake is expecting fast results. Our brains naturally love immediate rewards. We enjoy instant messages, same-day deliveries, and quick entertainment. Investing doesn't work that way. Real wealth often grows quietly. At first, progress seems slow. Then something remarkable happens. The returns begin generating their own returns. Small gains become larger gains. Time becomes more valuable than perfect timing. Many beginners quit just before this process begins working in their favor. Another common mistake is confusing luck with skill. Imagine someone buys a random stock and doubles their money in a few months. They may believe they're naturally talented, but sometimes they were simply lucky. Luck can feel exactly like skill in the short term. The danger comes when confidence grows faster than knowledge. That's when investors begin taking bigger risks, believing every decision they make is correct. Eventually, reality catches up. The market has a way of humbling overconfidence. Another invisible trap is constantly checking investments. Every notification creates emotion. Every market movement feels important. But here's something surprising. The more often people watch short-term price changes, the more emotional they become. Instead of thinking like long-term investors, they begin reacting like gamblers. Successful investing often requires doing less, not more. Patience may look inactive on the outside, but it's one of the hardest financial skills to master. Another major mistake is investing without understanding what you're buying. Many beginners purchase companies simply because everyone else is talking about them. They hear exciting stories. They see rising prices. They don't actually understand how the business makes money. When prices fall, they panic because they never had real confidence in the investment itself. Knowledge creates patience. Blind excitement creates fear. Another psychological trap is chasing what already went up. Human beings naturally assume that what has been successful recently will continue forever. When a stock becomes popular, thousands of new investors rush in. Ironically, many buy after most of the gains have already happened. They arrive during the excitement. Then they experience the correction. This creates the painful cycle of buying high and selling low. The exact opposite of successful investing. Let's talk about emotions. Fear and greed control far more investment decisions than most people realize. When markets rise, greed whispers, "What if everyone else gets rich except you?" When markets fall, fear whispers, "What if you lose everything?" Neither voice is interested in logic. Both are trying to protect your emotions in the short term. But successful investing often requires doing something emotionally uncomfortable. Sometimes that means staying calm while everyone else is celebrating. Other times, it means staying calm while everyone else is panicking. Another mistake beginners rarely notice is believing they need to predict the future. People constantly ask, "What will happen next month? Which stock will explode next year? Is now the perfect time to invest?" The truth is that consistently predicting markets is incredibly difficult. Instead of trying to predict every movement, experienced investors often focus on something much simpler. They prepare for uncertainty instead. They diversify. They think long-term. They accept that temporary declines are part of the journey, not signs of failure. One of the biggest hidden mistakes is letting comparison destroy confidence. You see someone online claiming they made huge profits overnight. Another person says they retired early. Someone else shares screenshots of extraordinary returns. What you rarely see are the mistakes, the losses, the years of patience, the opportunities they missed. Comparing your beginning to someone else's highlight reel can push you into unnecessary risks. Your financial journey is unique. It doesn't need to look like anyone else's. Here's another lesson many people learn too late. Consistency usually beats intensity. Someone investing a reasonable amount every month for many years often builds more wealth than someone constantly trying to find the next big opportunity. Simple habits repeated consistently can outperform complicated strategies driven by emotion. This isn't exciting. It won't usually go viral, but it's how many fortunes are quietly built. Now think back to Alex. What if, instead of chasing trends, instead of reacting emotionally, instead of searching for quick profits, Alex had focused on learning, patience, discipline, and long-term thinking? The outcome would likely have been completely different. Not because the market changed, because the investor changed. That's one of the most powerful lessons in personal finance. Your greatest investment isn't always the money you put into the market. It's the mindset you develop before you invest. Markets will rise. Markets will fall. News will change. Predictions will come and go. But discipline, patience, and continuous learning remain valuable in every market condition. Before we finish, I'd love to hear from you. Which investing mistake do you think is the most dangerous for beginners? Have you ever made one of these mistakes yourself, or are you just starting your investing journey? Share your thoughts in the comments below. Your experience could help someone else avoid an expensive lesson. If you enjoyed this video and want more content about investing, saving money, financial psychology, and building lasting wealth, don't forget to subscribe, like the video, and share it with someone who wants to become a smarter investor. Remember this: the people who become wealthy aren't always the smartest. They aren't always the luckiest. More often than not, they're the ones who avoid the biggest mistakes, stay patient when others panic, and allow time to do what it does best. Because in investing, success isn't about moving faster than everyone else. It's about staying in the game long enough for smart decisions to compound into extraordinary results.